The monetary precious metals had a mixed week in fiat price performance. Gold showed strength in this past Tuesday's trading action, and the spot gold price briefly eclipsed 1,440 fiat US dollars per troy ounce, only to give away about $40 of those gains to close the week right around the important psychological level of $1,400. Silver was not as rambunctious to the upside, closes the week around the important 15 fiat Federal Reserve note per troy ounce handle. The gold-silver ratio is still climbing higher to touching near 30-year highs, closing this week around 93 troy ounces of silver derivatives to afford 1 ounce of gold in derivative format. This week we're going to take a long view out for the next coming bull market in commodities and these very same two aforementioned precious metals. Before we get into this in-depth discussion with Jordan Roy-Bryne about where he sees silver and gold going and why, we have this short word from our show's sponsor. SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. We are committed to being your trusted source for low cost, highest quality investment grade bullion products. Visit SDBullion.com for more information. Welcome to this week's Metals and Markets Wrap. We have a now returning guest to this Precious Metals podcast. He is Mr. Jordan Roy-Bryne. He's back with us today. He is the editor and publisher of thedailygold.com. Jordan has an updated manuscript he'll be offering for free on his website soon. Oh, actually now. We just discussed that in the pre-roll. It's entitled The Coming New Bull Market in Gold, Why Precious Metal Investments Will Flourish in the 2020s and 2030s. Jordan, thanks for coming back on our podcast.
Hey, James. Thanks so much for having me back. It's a real pleasure to be on.
So, Jordan, when you wrote in the first edition of your book, it was written in 2015, you stated valuations for gold mining companies were approaching historical multi-decade lows, and that has barely changed since. Gold bullion, in comparison to many things currently, continues to be as cheap as it's been in decades. Silver, by comparison, is even cheaper. Is that, essentially that take, I think a lot of people listening would agree. If anyone's been tracking precious metals since 2015, that seems to be the flat out truth.
Yeah, that's absolutely true. And I don't think people are aware of, at least a couple of years ago back then, exactly how cheap things were. I mean, you see graphs on Twitter where people are showing like 5 or 10 year charts, and that bothers me because you really need to look at as wide or as long of a historical lens as you can use, because if something's as cheap as it was, 5 years ago or 10 years ago, great. But how does that compare to 20 years ago or even 50 years ago? And so getting historical data from the Barron's Gold Mining Index, the S&P TSX Gold Mining Index, and of course looking at the price of gold and silver going back 100 years, it was fascinating to me back then, middle of 2015 and towards the end. That was the point where gold stocks, I think, were the cheapest of all time. Yeah. I mean, or at least the cheapest in 90 years. And silver, I think, I don't spend as much time on that as I do the gold stocks, so I don't have the chart in front of me. But actually, silver right now, in relative terms, maybe it's even relative to the S&P. It's probably, as far as its historical cheapness, I want to say it's like in the 97 or 98th percentile. I don't think it's quite as cheap as it was in 2000 in the 2001 low, but that just, looking at 100 years or 80 or 90 years, whatever it was, it gives you an appropriate historical lens, because when something's at a 5-year low, yeah, that's great. But if it's at a 50-year low or a 100-year low, that literally tells you that, something historic is going on here. So I love looking at as far back as I can with the historical data of all these things.
Yeah, Jordan, I really appreciate that, and I share that sentiment with you. We're talking about commodities or general gold mining stocks, and there's data that goes back way, way back, and having that full spectrum and that perspective, I think, is really important to understand generational low points potentially for different commodities. So I definitely appreciate that sentiment. You stated in your manuscript, you state that you expect rising inflation in the 2020s for two reasons. We may have seen an end to the secular downtrend in inflation, and inflation is the only realistic way of the government debt bubble, which will become a more pressing matter in the years ahead. You also state the long-term bullish case for gold is driven by the inevitability of rising inflation and negative real interest rates as the only way the federal government can get its seemingly ever-growing record-sized debt levels under control. So essentially, you're saying, I mean, we're going to have to debauch the currency further. That's essentially the easiest way out.
Absolutely, and this is not like a debatable point. It's just a question of when we're going to have to reinstitute the policy that we had in the 1940s, where the Fed funds rate was kept at 1%, and I believe until 1948, and then they kept the 10-year yield. They had a ceiling on it of about 2.5% until 1951, and I believe debt to GDP peaked in 1947, and that started going down after that point. And when they basically let inflation run, and if you look from about 1945 to 1951, there's some statistics in the book, but during that 6 or 7 year period, I think real GDP growth was very little, like it was in the single digits. However, nominal GDP growth was some big number. I don't have it off the top of my head, but I want to say it was 50% or 70% or something like that. So basically, the only growth we were getting was inflation. So if you think of real growth is basically it's nominal growth minus inflation. Mm-hmm. And what we need in order to grow and inflate our way out, we need nominal growth plus inflation. So, and I give the example in the book, it's better for us if we had, let's say we had nominal growth of 6%, but only real growth of 3%. So we'd have 3% inflation, real growth of 3%. The 6% of nominal growth with the 3% inflation, that would be better than if we had 3% real growth with zero inflation. Mm-hmm. Even though it's more healthy to have that 3% with zero inflation. So that's how you grow your way, inflate your way out of the debt problem. And the real issue, I think, the real catalyst for when this is going to become apparent or start to accelerate, that's going to be when the rate of inflation, I think, it's been in a 30-year downtrend. When it breaks above, I want to say 3%, maybe 4%. When it gets above those levels, that's when this is going to hit the fan. Sorry for my bad language there, but that's honestly when the is going to hit the fan, and we're going to see higher and higher levels of inflation. And because of the debt situation, they're going to have to keep interest rates low. That's going to be the trigger, I think, for when we see precious metals really in a real hyper bull market. I don't think it's a couple years away. If you put a gun to my head, it's just a guess. I'd say, I don't know, maybe it's 7 years away or 6 years away, 5 years away, 8 years away. I don't know, something like that. That would be my guess. Mm-hmm. So that a policy like that is coming. Like it's not a debatable point. Like this is just math. It's just a question of when are we going to get to that point? Mm-hmm. Now, another thing, as far as and the other important thing I should mention with in regards to the question is, I think the policy that we're going to get, after the next downturn or the next recession, is we're going to see more in policy that's directly inflationary. We're going to see, probably more infrastructure spending. Mm-hmm. The government is going to look to use QE, or excuse me, the Fed is going to look to use QE to finance infrastructure spending and deficit spending, because that's how we can get money, directly into the economy and directly into the hands of people versus what we've had before, which is basically the QE and the money printing, it just propped up financial assets. It didn't go into the economy. So when those policies actually result in money going into the hands of workers and taxpayers, and the government is directly spending on infrastructure projects and things of that sort, that is going to trigger more inflation. And politically, that's actually what people want.
Mm-hmm.
They don't want to see QE and the economy growing at 1% and the stock market shooting higher. It's just politically unacceptable for that to happen. So people are saying, oh, well, we're not going to have inflation. We're going to have low inflation forever. They're not looking at how Fed policy is going to change and how we're going to be able to direct the money into the economy, in the next decade, where it's going to cause inflation. I didn't even mention the MMT thing.
Right.
So I don't want to talk about that, but you can just see when you look at these things from a bird's eye point of view, you can already see that, sentiment as far as, workers and taxpayers and voters, it's shifting. We don't want to see this QE and financial assets being propped up. The income inequality is out of control.
Right.
We're going to, so in other words, as I explained, we're going to see policy in the next decade that starts to result in inflation. And look, some of these things, it can take a little time for it to work through the system and inflation to start to ramp up. And that's why, my guess as to when we're going to see inflation really break out, technically, it's 5, 7, 8 years away. It's not a 1 or a 2 year thing. And just the last point on that, when I'm talking about inflation, I'm talking about statistical inflation. And another way to think of that is just commodity prices. So when you're analyzing, these macro developments, how markets move, and how, large funds put money into various asset classes, just think of inflation as statistical inflation or changes in commodity prices. Mm-hmm. Don't think of it as the cost of living. We know that the cost of living is going up at a much faster rate, but you can't apply that thinking to this analysis.
Mm-hmm. Yeah, I mean, so many tangents in my head when you were going through this. I want to swing, I suppose, to the first chart that we're going to put into this video. You had figure 4.5, it's debt to GDP and inflation. And it's a long-term chart going back almost 100 years, beginning in 1929 all the way to today. You spoke a little bit about World War II. The last time we had a situation where, debt to GDP was roughly this high. It sounds like people who owned bonds around that time pretty much lost almost everything in terms of purchasing power that were in those bonds. Am I correct in making that statement?
Yes, but I think they were fine really until I want to say the 1960s. Mm-hmm. So they came out okay. And by the way, I think the best historical analog for where we are is the early or perhaps mid 1960s, just to give you that point of view. Mm-hmm. But yeah, so as far as bonds, I think people were okay really until the 1960s. However, and you're absolutely right. It's all about purchasing power. Don't try and short bonds. It's extremely, if you talk to skilled traders and money managers, they'll tell you, don't try and short bonds. It's extremely difficult. And in nominal terms, bonds are going to go higher, but you said it, their purchasing power is going to be destroyed over the next decade or two. Mm-hmm. Bonds is definitely where you don't want to be. But yeah, with respect to that chart, I think you mentioned 4.5. 1947 was really the point when we got debt to GDP to turn lower, and once that continued, I mean that had a big drop off over the next 5 years through 1951, and then it steadily declined. I think well into the end of the 70s. So, but our debt to GDP is still going up, so we have to get that under control at some point, and the only way that's going to happen is with nominal growth and inflation.
All right. Well, switching gears, we're going to move to the next chart. You wrote about gold's relationship with the S&P 500, which is essentially a valuation for the U.S. stock index. Leads you to an important point. Gold has never experienced a real bull market without simultaneously outperforming the U.S. stock market. Where are we in those terms? I mean, obviously we're pointing out, into the mid 2020s for that direction potentially to really start shifting backwards, at least from where it currently is. But I'm looking at the gold and S&P 500 chart that you created. Any thoughts on that?
Okay, yeah, this is also something I could take into a couple different directions, because it's also, we're at present day, we're at an interesting point because gold has broken out to a multi-year high and the S&P 500 has also broken out. So I want to give this some nuance because it's not the relationship. Excuse me. The relationship is important, but there is some nuance to it. I want to use the 60s again. If you go back to the 60s, it's interesting because commodities, the CRB started to outperform the stock market when the rate of inflation broke out in 1968, I believe it was. And then from that point forward, commodities performed fabulously. They outperformed the S&P 500. However, earlier in the 60s, it's very interesting. Gold stocks did fabulously well the 7 years before that. Silver also nearly tripled from 1960 to 67. Platinum, I think, went up about 300%. So there are some, it's not as cut and dry as you think. But you made a good point about, the middle of the next decade, because I think with respect to commodities, what we are going to see is, and just stepping back, going back to that point I mentioned, 1968, that was when the CPI broke out. Like, it was kind of going sideways for a while. It started to increase a little bit in 1964, and then towards the end of the decade, it had a clear breakout and it was rising. And from that point forward, again, that's when the S&P's bull market in real terms ended. Now, that trigger point, I think, is going to be when the CPI, it's been in a 30-year downtrend. When it breaks above, I want to say 3% or 3.5%. When that happens, then you're going to see commodities outperform the stock market, for another 10 or 15 years. But we haven't got to that point yet. Sure. And also, which is interesting, is I mentioned, the performance of precious metals from 1960 to 1967. If you look at the gold stocks, they actually bottomed relative to the S&P in 1960. And after 1964, their performance really accelerated. With respect to silver, I think that silver to the S&P, I think that also bottomed in 1960, but it kind of went sideways for the next 5 or 7 years, so there wasn't strong outperformance there. But anyway, I think we could be seeing something similar right now, where we're seeing, precious metals are performing very well. I mean, not silver yet, but precious metals should continue to do well over the next 5 or 7 years, before we get this breakout of inflation and the CPI going above 3%, going above 4%. When that happens, that'll be the point again when commodities as a whole outperform the S&P 500. But from where we are here until then, I think precious metals, gold and gold stocks, or at least the gold stocks performance relative to the S&P, that's already bottomed. Now, gold against the S&P, that ratio has increased a little bit, but it hasn't really confirmed a bottom yet. And so it's tough to call and analyze that further, because I do think even if we have, assuming we get a downturn in the next year or two, the stock market may be okay coming out of the next downturn, but I think at some point during that recovery, like, that's when you're going to see the inflation problem I talk about, and that's when you'll see commodities really start to strongly outperform the S&P. So I know that's kind of a disorganized or disjointed answer, but there's a lot of directions we can take that in. But so, it is possible that precious metals can perform okay or well with the S&P rising, but I'm watching gold against the S&P 500 every day, because if you look at that ratio right now, the peak of the last 1 or 2 years is around 0.54. And if that ratio, if we get above that ratio, then on this move in gold is going to go to 1900. Like it's going to retest the high in the next 2 years maybe. However, if that ratio doesn't, if it fails to break out in the next year or two, then this move in gold is probably going to be capped at, I don't know, 1600 or 1700. So I mean, precious metals there's still periods where they can do well and perform with the stock market rising, but they really need to be outperforming the stock market to have a rip-roaring bull market. Because look, if the stock market keeps going up, a lot of capital is going to stay there. It's not going to move from stocks into gold. So we really need, if you want to see a rip-roaring precious metals bull market, you need gold to outperform the S&P.
Now, I'm just thinking demographically, right? I mean, you're talking about the baby boomers, who are probably the majority of the retail folks out there who own stocks and various equities for their retirement savings. And, they're going to have to sell some of that stuff when they're retiring and living off of the proceeds, right? So the question then becomes, well, who in the younger generation is going to be running headfirst into the stock market when valuations are at near, all-time highs? So it throws more nuance, more thinking into this whole, looking out into the 2020s, even beyond in the 2030 spectrum. I wanted to swing over to the silver S&P 500 chart because you had mentioned it earlier. It looks like we are near very low valuations currently, not at the lowest valuations like you had mentioned around the year 2000. But silver versus the S&P, silver versus the stock market is historically very cheap. And this chart that we're showing right now, that's a chart with 120 years of data almost. So it goes back to our point of using more long-term methodologies in order to understand perhaps when generational lows may be being made.
Absolutely. And yeah, as I said earlier, and I'm scrolling to that chart now, yeah, it looks like we're in the 97th or 98th percentile of cheapness. And I think silver, I think if gold, when you see gold go above 1420, make a daily close above 1420, I think you'll start to see things pick up in silver. If we have an increase, I don't know how this economic expansion is going to end. Maybe it'll end with higher inflation than I think. I mean, that's possible. But if it does end with rising inflation expectations, then you're going to see silver start to outperform gold. And people should remember, coming out of the bottom, the precious metals bottom in 99 to 2001, that double bottom. Remember, gold stocks bottomed November 2000. Gold bottomed. It also did a double bottom, I think February and April 2001. Silver didn't bottom until late 2001, and it really didn't start to perform strongly until some point in 2003. So the gold silver ratio did not peak until 2003. So I don't want to say, well, we're exactly repeating that cycle, but if you look at history, there's obviously a comparison to a time when a rip-roaring bull market began that would last many years, but silver was the last to get going. So we could be seeing something similar this time. So I'm not that concerned about silver. I know I saw some people on Twitter saying silver is being manipulated. I'm sorry, I'm not a big fan of that argument, but I just find it funny that, okay, well, gold, they're manipulating silver, but they're not manipulating gold at the same time. So it's just funny to me. It doesn't make sense to me. But anyway, silver is it's the cheapest asset out there, honestly. And when you look at, because I know we're going to get into it later in this interview, but when you look at my long-term inflation cycles and kind of projection for when all this stuff is really going to play out and peak, I mean, silver is going to be trading much, much higher. There's data that argues that it could be trading at four digits when this is all over. So I think the silver bull's just relaxed. It's super cheap. It's going to start to move at some point, probably fairly soon, when gold goes above 1420. And look, if you just accumulate a little bit of that every month, you're going to be totally fine over time.
Yeah. So I oftentimes, especially the last 6 or 7 years of frustration for precious metal bulls, I've always felt the sense that patience is almost more precious than the metal itself. I mean, the amount of patience that's going to be required here, especially if your timelines play out as long as you're potentially suggesting. So it's just one of those things. If you want silver to double tomorrow, you may be waiting for a while, and you may be getting frustrated very quickly. So you have to have a longer term perspective. So there was a couple of charts that you put in there that reflected the under allocation of gold or to gold currently versus other financial asset classes. Particularly the first chart I'm looking at here, you got the market value of above ground physical gold divided by U.S. financial assets. And if we're looking at the this chart, it goes back to 1929, and so we're talking about a chart that's roughly 90 years in length. Currently, the prices versus for gold versus U.S. financial assets look rather depressed if you're thinking about what the median of this chart is, and it's obviously what the tops of this chart is. And then the other chart that I was going to show to the viewers, and if you're listening, just listening to this podcast, you can always go to our YouTube channel at SilverDoctors to see these charts that we're swinging through. The next chart was figure 3.5, gold as a percentage of ETF assets. It was hovering anywhere from 6 to up to 9% at its peak in 2013. And as gold's prices underperformed the next 5 or so years, the amount of allocations to ETFs has precipitously fallen. It looks like it's just above the 1% level at the current moment. What are your thoughts on the current world's allocation to gold in terms of where it is now and potentially where it could go?
Well, it's extremely low, and as far as where it could go, I'm not sure it's going to go to where it was in the early 30s and also in the late 70s. The reason I say that is because there's more inflation hedges this time around. Like back then, you could only, well, it was illegal to own gold basically. So you could, that's why people bought gold stocks. But back then, you really could only own silver or gold stocks, or in some cases gold. Now you can have, you can invest in emerging markets. You can own foreign currencies. There's emerging market ETFs, and so there's more options now. So I don't know, because there's some charts showing that precious metals were 30% of allocations, right. Back in 1933. Like, I don't think we're going to get up to that. You better hope we don't get up to that point, because that's going to be really, really scary if we actually get that high. But I mean, no, I think, if gold goes above, if it goes into the 5 digits, which I think is possible in the next 20 years, I don't know what the allocation, if it would be 10% or 15%, but it's not going to go up to like 30%. But anyway, yeah, looking at the chart you showed, we're just above 1% now as far as, private client precious metals ETF allocation. And the peaks in 2011 and early 2013 were around 9%. So there's a lot of room for people to get back into precious metals, and I'm talking about the average people, that not the listeners of this and people in the precious metals world. But getting to the other chart, I mean, this shows the market value of all the above ground gold against the value of U.S. financial assets, and it's very interesting because the peaks of that were 16% in the early 30s, and then are basically around the same level, 16% during the 1980 peak. And right now, I mean, this chart's a little bit old. It looks like we're at about 3%, 3.5% or so. And thanks to Tocqueville Gold, who had this in one of their letters. But I mean, this chart, I mean, these are so helpful, because you can see what happened. Where was the value of gold relative to other assets when we had the major peak in 1980 and the major peaks in the early 30s, or even 1942. The 1942 peak was just slightly below the other two. But this just gives you a perfect snapshot of history. And it tells you, look, if gold goes and gets back to those levels, which is going to happen at some point, I mean, the price of gold in dollars is going to be much, much higher. I mean, at least 4 times higher, but probably even higher than that. So again, I mean, I know I'm just preaching to the choir because you've mentioned it. It's so important to look at 100 years of history, and especially these types of comparisons where you can compare the value of gold or the value of silver to the value of something else, because it does a better job of putting it in perspective versus just nominal, nominal price levels.
Right.
Because last point I'd make, if you tell that an average financial professional gold's going to go to $10,000 an ounce in 10 or 20 years, and obviously they won't believe you. They'll say you're an idiot. You don't know what you're talking about. You're a gold bug. You're a doomer. You're a prepper. No, but there's actual data that backs this up. Like, this is just math and data. Like, at the end of my book, I give out, what kind of price levels we could be looking at in the 2030s. I just put aside all my bias and I'm just looking at math, and they come out much higher than people think. So I'm sorry to go off on a tangent.
No, it's no problem. Anytime you start throwing out massive fiat Federal Reserve note valuation targets for gold, it can get really silly, as far as the size of the nominal price target potentially. There's been lots and lots, hundreds of people out there on the internet sphere who've been wrong for years with their ridiculous price targets in shorter term timeframes. But in the end, it's really what we're talking about is value. Value is the key, right? It's the question of what's the value of gold and silver now versus what's the value of gold and silver in 10 to 20 years. How much more can it get you in real stuff and services, etc. And all we're saying here is essentially with this massive chart that we're looking at is that, it looks like, if you look from like 1968 to 1980, what we see from 2000 to today is essentially a stretch job of that same story. It looks like, your targets for 2020s, 2030s even could potentially play out if we see a repeat or a rhyme of the last time we had an inflationary scenario or stagflation scenario. So all points well taken. I just wanted to kind of clarify it, I suppose, in my own words. So you wrote as well about U.S. equities that they're likely to generate only 2 to 3% per year over the next 10 years, and that the bull market in real terms could end during the next expansion when the CPI reaches 3% or slightly higher, and that then hard assets should outperform. And you expect gold stocks and emerging market stocks should perform best over the next 10 years. Any further thoughts on that, Jordan?
Yes, I would say, we covered this a little earlier, but I would say with respect to the stock market, if you look at, if you project 2 or 3%, now based on some of this, this data changes every week and month, I've seen, because, that chart that I was using, I want to say it's like 6 or 9 months old. So because of the correction that we had and, time going forward, the projection might be 3 or 4% now. I don't know, but if you project that out going forward, and then you project the S&P and just all those things tell me that we're in a repeat of the 60s and 70s. And as we said before, everybody knows about the Dow peaking in 66, but the S&P didn't actually peak until, it actually made it made higher highs, but they were marginal. So in real terms, stocks basically peaked in 1968, but that's against commodity as a whole. But I already said earlier against, gold, against gold stocks, they peaked in 1960. So, this time around, I'm thinking that against hard assets as a whole, it'll probably be sometime around the middle of the next expansion or the middle of the next decade. That's when stocks will peak in real terms. But as I said, if you look at nominal terms, the S&P, it kept it in the mid 60s until the late 70s. It kept making marginal higher highs. So I think we could see something similar. I don't think we're going to see like a massive deflationary bust as some people are predicting. The banks have been recapitalized. They're in much better shape, at least in the U.S. So I don't, and again, the government, when we look at the policy that we touched on earlier, the government is going to look to, as long as interest rates are super low, they can do QE again. The central bank can, direct that money to infrastructure projects. Mm-hmm. And so on and so forth. So looking at the lens we really need to look at this is the 1960s and 70s, not a repeat of 2008 or 1929.
Right.
And so all the data that projects forward returns says 2 or 3% a year. So it's just factual data. Maybe they'll do 1%, maybe they'll do 4%. I mean, we can't predict the future, but given where, and look, we know that valuations are at extremes, but when you look at what happens, there are historical examples there's several historical examples of what happens to the stock market when valuations reach extrees. You can get a 1930s scenario, you can get a 2000 scenario, or you can get like a 1960s and 70s scenario where you have inflation. And so I think this time around, that's the kind of scenario that the stock market is headed for, where the huge valuations, it slowly and over time, they're going to go lower and lower, as we see inflation increasing. Right. Because inflation and valuations with respect to stocks, those are they're inversely related. When inflation goes up, stock valuations come down.
Right. You're talking about in real terms, a la Venezuela.
Right.
Right. Okay. Now, this final chart I wanted to pull up to close out our discussion is it's great. I mean, it's really, really a great chart. It's figure 11.1. It's a 10-year moving average of commodity prices. It's probably a chart that a lot more about, so I'm just going to let you kind of run with it. It's about the Kondratiev wave, and it talks about peaks in commodity prices, how they tend to be every 55 to 60 years apart. And so this kind of echoes with your analysis, suggesting that this bullion bull market, precious metal bull market, could take a lot longer to play out than most precious metal bulls are suggesting, perhaps. And you even suggest, you go so far as suggesting that the historic top in silver, in terms of coming prices, it may happen as late as 2040, which I'm sure a lot of people don't like that analysis in terms of 20 years from now. But that would kind of jive with this chart that I'm looking at.
Yeah, and this chart is from Barry Bannister, who's a strategist with Stifel, and I just want to say that this guy is super accurate. Again, it's hard to predict the future, but we can look at data, we can look at history, and kind of eliminate what's unlikely to happen and focus on what the possibilities are. And this guy Barry Bannister, I remember him. He was on Financial Sense in the early 2000s. He was a big gold bull. He was a big commodities bull. I remember seeing him on TV. I think it was early 2013, and he was saying, the commodities bull is over. It's time to get into the stock market. So this is a guy who has a very good track record. I mean, we know that strategists for Wall Street firms, they're never going to like gold. I mean, or rarely they will like gold. They're never going to discuss anything that might seem extreme to most people. Mm-hmm. But this guy, Barry Bannister, he really looks at the historical data and he pulls no punches. Mm-hmm. And so again, I just mentioned he has a track record that's very strong. And this chart shows that, again, there's been peaks in inflation every 55 to 60 years, going back to basically 1800. And what's interesting is it also shows that the peaks that we get in inflation, they tend to be higher and higher inflation as time goes on. So in other words, the inflation cycle that we had that peaked in 1980 was much stronger than the one we had that peaked in 1920, and that was stronger than the one that peaked around the time of the Civil War, et cetera. So that means that the next peak, which Barry projects, I think 2036 to 2041, that peak of inflation is going to be even stronger than the peak that we had in the early 80s. Wow. So, but one thing, a couple more things on top of that. so this chart argues 2036 to 2041. But what's interesting is if you look at silver, for example, it's not just silver, but it's commodities as a whole. They have had peaks every 30 years, going back to basically 1920, and in silver and commodities have had major peaks every 60 years. You had Civil War 1864, then 1920, 1980. So the next major peak could be around 2040. And there's also peaks every 30 years because you had 1920, then you had 1951, then you had 1980. The last peak was 2011. So the 30 and 60-year cycle, they line up together with roughly 2040, and then you have this data from Barry Bannister, which projects 2036 to 2041. And if you think about it, a lot of these things in the economy, like, they take such a long time to play out. I mean, statistically, inflation is probably at the beginning of a secular upturn. So look, if we have a recession at some point the next year or two, inflation's going to go lower, and then you have a recovery and inflation starts to trickle up. I mean, it's going to take, based on that's 5 or 6, maybe even 7 years before we see statistical inflation turn around and start to rise aggressively. Unless we have some weird kind of blow off to this cycle, we're not going to see, accelerating inflation probably until the middle of the next decade. And so when you project that forward, you can see, why it's going to take a while for inflation really to accelerate and get out of control. And so when you factor in, realistically, when could that start to happen? I mean, you're getting into the end of the next decade, and, and then you might have a recession, and then you have another expansion after that where inflation, it goes even higher and higher. So you're projecting into the 2030s then, and you can see how it's going to take a while for this to play out. And look, this is very strong history that's arguing. And Barry mentions it in he has a PDF document that I think it's public on the internet somewhere. It's old, but I mean, it's still highly relevant. And he talks about the government debt problem and how we're basically, he mentions the 2030s, basically when we're going to have to let inflation run wild to get out of the government debt problem. Yeah. So, and look, we don't know this historic inflation peak. Maybe it's 2036, maybe it's 2041, maybe it's 2038. We don't know exactly when, but this historical data argues very strongly that it's going to happen around that time. And look, when we look at the historical data that we have, like the S&P 500, when we factor in, okay, it's going to do 2 or 3% a year. It's at 3,000 now. If you do 2 or 3%, going forward, 10 years from now, it's going to be 3,700, 3,600, 3,800. I don't know, something like that. And then, maybe it's flat for the 2030s. But James, if you look at these peaks, the gold to the S&P 500 ratio, the historical peaks have been at 4, 5, 6. I mean, a peak of 4 times nearly 4,000 S&P, that gets you 16,000 gold. Right. And look, historically, I know that the silver bugs who followed this they followed the data back 100 years, the peaks or the valleys in the gold to silver ratio, 2 or 3 times they've happened at 16. So if gold's going to 16,000, that means silver could peak at $1,000 an ounce. I know that sounds ridiculous to most people, but this is just math. It's looking at the historical data. Again, I'm projecting this is 20 years away, and something like this is going to happen. It's not going to happen soon, but you have to think about where things are going, where this peak could ultimately be, and then think about, look at what happened to precious metals in the 60s and 70s. We're not in the 80s and 90s again. We're probably in the earlier mid 60s right now. And look, gold stocks had a 20-year bull market from 1960 to 1980. If the gold price wasn't fixed, the gold price, it wouldn't have gone up as much in the early 70s because it would have already gone up in the 60s. I think it would have gone from 35 in 1960 to probably the low 100s
right.
by 1970. I mean, again, going back to what I mentioned with look how silver performed in the 60s, look how platinum performed, look at how the gold stocks performed. So, you know, I don't misconstrue my words. I'm not saying, you know, we're going to do nothing for 10 years. You know, you have to wait 10 years to make money. No, I'm saying look at the 60s and 70s. We're at the beginning of what's going to be a 20-year bull market. It's just going to, you know, to get to those 15,000 gold and, you know, hundreds, you know, $500,000 silver, that's far off. But we're still going to see an increase, you know, a very strong increase in prices, I think, over the next 5 to 10 years.
Now, just speaking from personal experience, you know, I've been in this industry and been investing in precious metals since 2006 or 7. You know, I didn't have the ability, nor at the time on the internet was it so easy to see these long historical charts that we've kind of gone through. My perspective at the time was a lot more shorter to medium term than what we're discussing today. In our pre-interview, you know, I had a little bit of a joke with people, if they're online and they look and they see stuff about silver. There's this meme out there where this guy, he's a skeleton at a computer desktop, and the meme says silver $55 tomorrow, and the skeleton is essentially dead, just sitting on the desktop. So we were, you know, it's like gallows humor, you know. I mean, a lot of people who were young, who got in this space, you know, maybe like the Bitcoiners of today, thought, you know, that silver was just going to go to the moon and there would be no rough times. And so you know, we had talked about how, you know, there's a lot of older people now who maybe don't have that much time left in their lives. And so, you know, it's just one of those things. People need to understand that this can take a lot longer than perhaps they're hoping.
Yeah, absolutely. I mean, many of the old guard are probably going to pass away before they see the historic top. But I mean, if you're under 60 and in good health, you know, you're probably going to see this all play out. But look, if you're even 65 or 70 and you live another 10 or 15 years, you're still going to see record prices for gold, silver, and gold stocks. And I mean, where we are, again, I just really want to stress the point of the 20-year bull market in the 60s and 70s, because the cheapest that gold stocks had ever been, if we're looking at like a bird's eye view, I mean, it was really basically the late 1950s and, you know, the year 2000 and now. So, you know, I'm not trying to say that like you're going to have to wait 20 years to see these record prices. No, you're going to have to wait 20 years to see the ultimate historic top. But as I just said earlier, you know, 5 to 10 years from now, we will have record prices in precious metals. So, so this is a great time to be investing in precious metals. It's just that when you look at this historical data, you have to understand the historic peak that's coming. Again, we can't predict the future, but all this historic data, it argues that the historic peak is more likely 15 to 20 years away than 3 or 5 years away. I mean, no, we're not going to go to like 5,000 gold or 10,000 gold in 3 or 5 years. It's going to take longer for that to happen. But precious metals are still going to perform well. We are at the start of a 20-year bull market.
The one counterpoint I guess some people would make is potentially some political fix where, you know, we see something a la 1933 where there's some type of confiscation or this or that, and they rejigger arbitrarily the price of gold to force inflation. You know, a couple of years back you had Harry, I forget his last name, this guy from PIMCO. He published it was really interesting to see PIMCO's letterhead on somebody writing about $5,000 gold of the Federal Reserve coming out and publicly bidding at $5,000 per troy ounce for private U.S. gold, right? So there are people out there, respected names, large, you know, multi-billion-dollar bond houses who have published such things. The idea of a political arbitrary solution to bring about the inflation that we've discussed. Because ultimately, that is essentially, I think, what the federal government and the Federal Reserve want, is to debase the current record-sized debt levels that we've gotten to. So it's not to say that, I guess it's just to throw in the extra idea that, you know, maybe there are a couple curveballs that could come about.
Absolutely. I mean, that's definitely possible, but I think that the policymakers are going to be able to continue to, extend this bankruptcy, but it's getting drawn out in a super slow fashion. And so if, unless there's some kind of extreme shock,
Right.
And the other thing is, like, the country has assets, the country has gold. I mean, I don't want to get into the whole Fort Knox thing, but let's just, the country has lots of physical assets. The country has lots of gold. There's a reason why central banks and countries keep their gold, because it backstops the currency if it goes worthless. But if you look at the data in my book, that's showing you what prices gold has to go to 100% back the currency, or 40% back the currency, which was the law back when we were under the gold standard. So, it's coming. Like, this is not theoretical. Like, this is coming. It's just a question of when.
Yeah. Well, Jordan, I really, really do appreciate you sending me the manuscript. I really enjoyed going through it. I didn't get to read every word from top to bottom. I didn't have that much time. I basically scanned the essential chapters that you had suggested. But in my scanning, I was thoroughly impressed. I thought that you did a great amount of work and research in creating it. And the fact that it's free on your website, I think if people have interest, if they enjoyed this video and they want to go deeper, would you give them how they can get the free manuscript that you created?
Yes, absolutely. Just go to thedailygold.com. There's a box there at the top, an opt-in box, and you should have the book emailed to you immediately. If not, if there's an issue there, you can email me and I can send it to you. But thank you for the very kind words, James. It was a real pleasure to be on with you.
Jordan, it's always good to have you on. Hopefully, in the coming year, we can have you on again to discuss where you see things are.
Absolutely. Anytime.
All right, Jordan, thank you.